Good morning, and thanks so much for tuning in to Stocks to Watch on BloombergQuint. I'm Mathew. The cues from overseas this morning aren't the strongest, so we'll know soon enough in another 20 minutes or so whether the gains are set to continue in India's equity markets. In the meanwhile, let's look at three stock ideas that you should watch out for. My guest today is Mayuresh Joshi of William O'Neill. Morning, Mayuresh, and thanks so much for joining me today. The first stock that I want to ask you about is a biggie, and it has actually done really well for itself. Bajaj Finance is the company. Assets under management for Bajaj Finance rose just under 4.7% sequentially, is what they've said in their latest update to 1.43 lakh crore in the December quarter, and it's down about 1% year on year. They have added 6 million new loans in the third quarter compared with 7.7 million, so less number compared with the year ago period. And they've also said that the total deposits have risen to 23,800 crore rupees. This seems to be along the lines of what they had guided for at the start of the financial year, saying that they will be a little cautious as far as the loans that they are dispersing. How do you look at this update in the context of where we are right now? And would you buy into Bajaj Finance right now?
Morning, Alex. Thanks for having me. So a large element in terms of a price move has already taken place over the last few weeks and months. And this is more in terms of the anticipation on how Q2 numbers played out for Bajaj Finance. Now, the commentary, you are absolutely right, was cautious ever since the lockdown was announced and what numbers got displayed in Q1. But if you look at the current business update from a Q3 perspective, assets under management approximately around the same levels on a year-on-year basis. When you're probably looking at the cautious approach that the management is taking in terms of underwriting its disbursements, whether it's the B2C consumer durable business loans that they're probably meeting out or the SME loans. I think cautiousness and improving business scale has been the mantra for Bajaj Finance in Q2. That probably remains in Q3 as well. Well capitalized, 28 odd percent, if I'm not mistaken, is the capital adequacy ratio. The liquidity surplus in excess of 14,500 crores gives the confidence in terms of the balance sheet strength that it carries. The deposit book also has grown at 10 odd percent in terms of a YOY comparison. So if you probably look at expectations, I think on how the next few quarters will build up, I think the management commentary is indicating that customer acquisition has been very, very robust. The disbursement growth and the deposit growth should probably get maintained at a good pace as well. NIMs might moderate a tad bit. Cost to income ratios will also start dwindling down. There's a lot of provisioning that they've probably taken onto their books in a prudent manner should start remaining at stable levels and start coming down. So I think ROE's improvement over the next few quarters is expected to remain good as well. So yeah, as per our own ratings, I think the EPS ratings look fantastic at this point of time. The price strength has been very, very good, an industry leader within its space itself. The move, though, has happened quite significantly over the last few weeks. So anybody hold on to the stock. If the markets are volatile and if the stock does manage to give some sort of a pullback, I think that is where I think new entry points can be added into the stock. But at the end of the day, as per our own ratings, I think it is a qualitative franchise that investors, if holding on, can probably hold on with the medium to long term.
All right, so that clearly is one of the stories of 2020, one of the successes of 2020. So hold on is the call from Mayuresh on Bajaj Finance. So the second group of stocks, I should say, is the metal counters, and they were fairly active in trade. They have been active for a little while. We've been hearing murmurs of strength in base metals. We've been hearing murmurs of steel prices going up. In fact, the latest is that there could be another hike in steel prices in January, and perhaps that is what really bolstered trade for the steel companies yesterday. Tata Steel gaining as much as 7.8%, Mayuresh. But there is this overhang all the same of this other variant of the virus, and we don't know yet what the extent of the damage that it can cause. Would you say that that warrants a little bit of caution, at least in the near term, for the next couple of weeks at least?
Yeah, so I think it's a perspective, right? If you're looking at a couple of weeks, you're looking at a couple of months and a couple of years. So I think what is largely happening for the sector as a whole is that inventory levels generally for ferrous or non-ferrous companies have been at absolutely low levels. Second, in terms of demand itself, if you're looking at how the Chinese data points are playing out at this point of time, even our own domestic demand, that is holding out very, very strongly. The third aspect to be noted is also that input costs have moved up quite significantly on a quarter-on-quarter basis. If you look at iron ore, coking coal prices, though they have come off a tad bit in the past couple of weeks, they're still at elevated levels. So I think the inherent need to push through prices, both in terms of input costs going higher for steel companies or non-ferrous companies as well, along with burgeoning demand that is expected to play out. I think this is something that is going to keep steel companies in focus. So from a quarter three perspective, I think the large consensus estimates are pointing out that numbers are expected to be very, very robust. Volumes will be strong, realizations should be strong, which will create a natural operating leverage onto their balance sheets and a significant jump in terms of reported EBITDA per ton. So ferrous companies definitely focus, all the integrated ones, companies like Tata Steel, who've got integrated operations in iron ore, something like SAIL, and partially something like Jsw Steel. I think they should probably have an incremental benefit of larger reported EBITDA per ton that probably comes through. So yeah, from a quarter three perspective, good numbers expected, probably factored into the price at this point of time. The outside risk factors, Alex, as you're pointing out, on the ferocity of what the virus can do, I think that is a large unknown that we are still dealing with. And if that probably happens, I think it's not just the metal sector, right? I think a lot of other sectors will also probably come into a damage. So yeah, I think from a results perspective and a medium-term perspective, I think these companies are probably poised to post good numbers. On our own ratings, I think the price strength is spectacular for these companies. The earnings strength is expected to hold on. So from a results perspective, definitely, I think a lot has got factored in, but expecting good set of numbers to continue for Q3 and Q4, both for the ferrous and the non-ferrous space.
If I were to put you on the spot and say from both ferrous and non-ferrous, which would be your picks? What would they be?
No, so they've already run up. They have already run up. So I think Tata Steel, JSPL should continue doing well, as I said, on both these angles that I've discussed in the ferrous space. Non-ferrous, obviously, I think have a look at something like an Hindalco, where the momentum can continue purely from a results perspective. I think largely integrated player again, the backward operations that they have also ensure the efficacy in terms of reported EBITDA per ton. And because their converting cost or refining cost is still one of the lowest in the industry, I think it probably stands a better chance. And as per the Q2 update, I think if it has to get repeated in terms of the show that Novelis had posted, I think the EPS rating, RSI ratings should also hold up for this non-ferrous players.
Right. The last counter that I have to ask you about is Affle India. And really, the simple point to ask is, after a 150% rise since the start of January, should you essentially take some money off the table right now?
So I think our strategy is very clear, Alex. I think our leaderboard strategy probably suggests that stocks like these will keep on making higher highs. Might show some amount of weakness in the interim, but probably those become important buy points or alternate buy points if they pull back in this journey towards its 50 DMA and start moving higher from there. It's moved significantly higher, but anybody holding on can hold on with that 50 DMA in focus. Fabulous growth. I think all these product-led technology companies are still expected to do very, very well. Strong revenue growth in the first half, 41%, 58%. The conversion rates have been very, very good as well. And therefore, I think the entire logic of the premise that reflects in the bottom line in strong EPS ratings, in strong RSI ratings in terms of the overall industry ranks, which is, again, I think non-comparable because very, very few competitors to directly compete with, reflects in ROEs in excess of 30%. So I think all the parameters that we've set on our ODL methodology in terms of top line growth, EPS growth, in terms of ROEs being more than 17.5%, margins being very, very good, I think it satisfies that 100%. So I think you can understand what our methodology is throwing up. So yeah, hold on, keep that 50 DMA in focus in terms of how that stock might react. But yeah, I think all these product-led tech companies should keep on continuing a good show in the next ensuing quarters as well.
Thanks so much, as always, Mayuresh, for joining me and speaking to you this morning. It's been a pleasure.
Thank you so much, Alex. Pleasure was mine.
And to you, dear viewer, thank you so much for tuning in. Hope this conversation was useful to you. Do stay tuned. Lots more coming up on Bloomberg Quint.